Hello, this is Angela Slaughter, and I am presenting to you some of the important elements in Chapter 2. In this chapter, we're going to be concentrating basically on personal financial statements and how to do the analysis of those statements. All right, so I want to remind you that this lecture doesn't take the place of you actually reading the book. You need to read the book to get the details so that you can pass the test. But I do try to take some time with each chapter and explain some of the more important concepts. Okay, so let's look at this personal cash flow statement that was submitted by Stephanie Spratt. Now, if you've already taken some of your accounting classes, you've already been exposed to an income statement, you've already been exposed to a balance sheet, and you're going to look at these documents and you're going to see some real similarities between what you use personally for your personal finance and what you use for business finance. But let's look at this personal cash flow statement. As you can see, Stephanie's got a $2,500 after-tax disposable income, and that's basically her take-home pay and what she's going to have available to pay on all her bills. Now, particularly in this economy, you don't really have a lot of interest that you're bringing in on deposits. You may not have that strong of a dividend stream, but those are also considered part of your cash inflows. And then, of course, your cash outflows would include anything that you spend money on: rent, cable TV, groceries, clothing. If you are a member of a gym, you include that. You would include your car expenses, the gas, the insurance. Now, you as students, you probably would have to include educational expenses, and all of that goes into your cash outflow. And when you subtract your total cash outflows from your total cash inflows, what you're left with is net cash flows, and that tells you what you can afford to put into savings or invest. Now, once you do a draft of your personal cash flow statement, you really can't be 100% sure that it's right. So one of the things that you should do is compare what's actually going on against what you think is going on. So in this case, Stephanie revised her cash flow statement. She used the actual amounts that she spent last month, and then she revised her expected amounts for this month. And this is just another step that you can go through as you start building up more accuracy in your personal cash flow statement. So the first one that we looked at was basically a draft saying this is what I think is going on. And then in the second 60 days, or the second month, she looked at what she spent last month, and then she updated her cash flow statement to make it a little bit more reasonable on what she expected to spend in that second month. And when you look at it over a period of, say, 2 or 3 months, and especially when you're recording everything you're spending, you come up with your expected amounts and your actual amounts of what you're actually spending. And the difference between the expected or the estimated amounts and the actual amounts is your forecasting error. And it's important to know where you may be acting a little differently than you think. In this case, Stephanie's expenditures on groceries a little bit less than what she thought. Her expenditures on clothing a little bit more than what she thought. So it's important to know where your money is going. Now, you're never going to account for 100% of your money. I mean, if you try to account for 100% of your money, you're going to make yourself absolutely miserable. But I think it's important that you determine what percentage of your money you want to account for, whether it's 95% or 90%. You know, every time you pay a toll, you may not want to take time to write that down, but decide what percentage of your disposable income you want to account for, and work off of trying to lock down that amount. Now, once you have your cash flow statement or your budget locked down, you multiply that out by 12, which will give you your annual expected expenses. Now, in this case, if Stephanie is working a $30,000 job, which is her disposable after-tax income, or she's actually working a job that pays her more than that because her $30,000 is actually her take-home pay. And you'll see that she's spending, when you look at the total cash outflows, she's spending about $25,200, and the difference is the $4,800, which would be the net cash flows, and that money would be available for savings or investment or some other asset that she wants to acquire. Now, the other financial statement that you use in personal finance is relates to the liquid assets, or not the liquid assets, but the balance sheet. And the balance sheet looks very similar to a business balance sheet in that it has both the assets and the liabilities and net worth shown on the document. Now, in a corporate balance sheet, you've got your total assets, total liabilities, and owner's equity. So the main difference between this balance sheet and the balance sheet of a business is, with a corporate or a business balance sheet, you're looking at owner's equity or retained earnings, and in the personal balance sheet, you're looking at net worth, which is the difference between the assets and the liabilities. Now, when we talked about analyzing the cash flow statement and coming up with a budget, we talked about looking at it over a period of time, monitoring your spending habits over a period of maybe 60 or 90 days, so that you could do a thorough analysis of your cash inflows and your cash outflows. With a balance sheet, you do it a little differently. The balance sheet is going to change slower than your cash flow statement, and it's basically a snapshot of what's going on during a period of time at a given point in time, like on January 31st or January 15th. So once you build up your personal balance sheet, you analyze it using ratios. And the ratios that you use allow you to monitor liquidity and debt and your ability to save. So let's look at this first liquidity ratio. Now, you may want to turn back in your book to to Stephanie Spratt's cash flow statement and balance sheet in the book so that you can follow along. But with a liquidity ratio, you're basically dividing your liquid assets by your current liabilities. And this is going to tell you what your ability is to cover short-term debt. So in Stephanie's case, she had $4,000 in liquid assets. She had $2,000 in current liabilities. And when you divided the liquid assets by current liabilities, you got a liquidity ratio of 2. And the higher that number is, the greater your ability to pay off your short-term debt. So, she can pay off all of her short-term debt twice with the amount of liquidity at her level of liquidity. So that's a very, very good ratio. Now, when you're looking at your ability to pay off your debt, one of the ratios that you use is a debt to asset ratio. And this is the ratio between your total liabilities and your total assets. And what this is going to tell you is, if you went in and you sold every asset you had, would you pay off all your liabilities? Now, in Stephanie's case, she's, again, in pretty good shape. She's got $2,000 in total liabilities, so that's all she owes. And she's got $9,000 in assets, so she definitely has a solid asset base. So her debt to asset ratio is 22%. Now, you want this debt to asset ratio as low as you can possibly get it, because the higher the ratio, the higher the debt when you compare it to your assets. So, you don't want a high debt to income ratio where you have such a high level of liability that you just don't have the assets to cover it. Now, the third thing that you want to look at when you're looking at your personal balance sheet, and actually you have to use both your personal balance sheet and your cash flow statement to calculate your savings rate. You're going to take your savings during the period, and you're going to take that from your cash flow statement, because that's where you're going to reflect that. And then you're going to divide, your savings during your period is going to come from your personal balance sheet. So you're going to take the savings that you've deposited in your personal balance sheet, that's going to be one of your assets, and you're going to show that, and you're going to divide it by your total disposable income, which is on your cash flow statement. and that's the amount of money you're bringing in every month. So when you take your savings from your balance sheet and you divide it by your disposable income coming from your cash flow statement, the savings rate that you get is basically the percentage of your money that you're saving. So in Stephanie's case, she saved $400 last month. She brought home $2,500, so she actually saved 16%, and that's a very high savings rate in this country. Most people only save maybe 3 or 4% of their income, and it's usually better to have your ratio somewhere between 10 and 20%. Okay, so if you have any questions regarding the video, submit your questions to the Chapter 2 discussion board.